basically, you know, you look at a don't cry about it kind of trade, DCAI, right? Because the stock's gotten ahead of you. You may not want to buy in here. I'm still looking for a pullback to get in. I think there's certain ways that you can use the options market to sort of play that, because going forward, whether they miss earnings on their next earnings outlook, you know, come October and the quarter after that, I want to own the stock on any kind of pullback here, because I think they're doing the right things to project themselves forward, get to the growth numbers that everybody was looking for, and so I want to be in this name, but just at a lower level.
Okay, so let's explain your playbook here. So Brian is making a bullish bet on Facebook by selling a put. Usually we buy puts, so let's explain just how this common strategy works. When you sell a put, you want the stock to go up. Specifically, you want it to stay above the strike of that put you sold by expiration. That allows you to keep the money you took in. However, because you are short that put, you could be forced to buy the stock at that put strike price, even if the stock falls below that level, and that could mean losses. That being said, Brian, what's the trade?
Yeah, Mandy, just to the point on the playbook here, you have to have a conviction to buy the stock when it gets down there, and I do. So what I'm basically going to look at is, come Monday, I want to sell a January, basically $36 put. Okay, so that's a strike price at the $36. I can collect $2.05. It was trading a little bit higher around this level earlier in the day. It's a little bit cheaper than that right now. But basically, by collecting $2.05, you know, that's basically 5% of the value of the stock here. Now, by selling the put, I'm selling insurance. That means I'm obligated to purchase the stock when it drops below $36. I want to do that. I don't care how the earnings look next quarter. I want to buy the stock if we get a pullback, so I'll keep cash set aside to do that in case I have to. And in the meantime, I collect my $2.05, earning some return on my cash, and it's a good way to sort of buy in on the dip, and hey, if I miss the upside from here, I do. But at least I made 5% in 5 months.
Absolutely. So, Mike, what do you think of that trade?
Well, I think one of the advantages here is that Facebook has no debt, so it's not a levered business. But we do see, obviously, a lot of positive momentum in the stock, and implied volatility is still rich enough that you actually are collecting meaningful premium for selling those downside puts. So, although I'm not so crazy about the valuation, for those that are inclined to get on the bull train on Facebook, I think this is a good way to do it. Okay,
well, let's wrap this up with a stocks versus options. Want to buy Facebook? Well, that will set you back $40 a share. Worst case scenario in Brian's trade, you could be forced to buy Facebook for just under $34 a share, or a 10% discount. Let's move on to the...
Well, okay, so for option traders, this is options action. We like to risk less to make more.
Right.
So here's a trade. I mean, if you don't understand options, you can go out and buy the stock. But I think one way to do it here is by buying the October 8.55 call. You can purchase that for about $41. At the same time, selling the 8.95 call for about $21. Net, you've played $20 here on the trade. Your break even basically is $8.75, which is right roughly where the stock is trading at. I believe Google can make a run and push towards $8.95, the $900 level. Does it get to $1,000 like a lot of people are talking about? I don't know. But this is a great way. Basically, you're risking $20 to make $20. And if things fall apart, you're stopped out below $8.55. You can't lose any more than that $20 you paid for this trade.
And what about you, Carter? Do you like Google at these levels?
I'm 100% behind that trade. I mean, I think 1,000's definitely within shot, and stock acts well. The recent pullback is orderly, and that's what you want for providing an opportunity to buy.
Okay, well, Carter's 100% behind it. What about you, Mike?
You know, one of the things that Brian's trying to do here is get into a position where he's long using options, mitigating that downside risk, but not spending a lot in decay. Oftentimes when you buy options, you have decay. By setting up this in-the-money call spread, you actually don't have that dynamic, so I also like the trade a lot.
Okay, lots of likes going on here for Google.
The thing about this one is, if the stock goes sideways, you don't lose that much money. You lose a tiny bit, but not much. And you would lose a fair amount of money if this was a completely out-of-the-money call spread. One thing, if Carter thinks it's going to $1,000, then this is not the trade, because this is only going to make money up to about $900.
Okay, good point, guys. Okay.